Okay folks, here comes a little bit of a different kind of video. This time it's going to be Excel based and it's going to be covering the cash flow statement. Now, cash flow is one of the absolutely crucial content pieces of finance and of our class. That's the reason it's very important for me that everybody understands what cash flow is all about. And I don't just want to go about giving you a formula, a definition of cash flow. I would like to develop now a little numerical example so that you understand what cash flow is truly all about. This is in particular important in this part of the world, Europe, where we are very much P&L focused, profit and loss focused. We love to look at the income statement. I would like to draw your attention a bit more to the cash flow statement, in particular in the days of crisis. Why does a company go bankrupt? Because it runs out of cash. So we need to understand how cash is generated from a bottom-up view, not just looking at an annual report and understanding some of the overall formulas in there. So let me introduce you now to Excel, my Excel sheet in here. It will be a different video as well because I will ask you to pause from time to time and think about the question I ask. And then once you actually came up with what you think is the correct answer, then I would like you to hit the play button again to actually see what is the correct solution. Because when it comes to learning effects, making a mistake is an extremely helpful thing to create knowledge retention in there. Yeah, so please do the effort now, and when I ask questions and I ask you to pause, do it, because then messages stick, and that might be very helpful, I think, for discussions we have about cash flow, which will come up. So what you see here, you can see a column called income statement, a column called balance sheet, another column called cash flow statement. This is now exactly what we need to do. We need to explain how those different parts of your annual report fit together. Now, you know that a balance sheet is one moment of time. You know that an income statement is a period of time, and so is a cash flow. A cash flow is a period of time. Now, I was kind enough to already include here your first period statement, which is your income statement or profit and loss statement. You can see here, this little company in the year 2020 had sales of 100, material expenses of 30, personnel expenses of 10, other operating expenses of 10, depreciation of 10, which brings us to EBIT. Earnings before interest and taxes are then 40. Then you can say we pay a little bit of interest, 10, which gives us earnings before taxes of 30. And you can see it must be a French company, healthy 50% tax rate. Yeah, so we pay 50% on the 30 as taxes, and that gives us our net income of 15. So I told you this video is about cash. We start off now with profit, net income. So here is the first time that you should hit the pause button. You should hit the pause button and think about the answer to the following question. The question is, how much cash did this company generate in the year 2020 in its business? So net income is 15. That's profit. That's not my question. My question is, how much cash did this company generate in the year 2020? Hit pause now, think it through, and write down a number in front of you, and then I will tell you which number is correct. Pause now. So, I hope by now you have a number written in front of you. Now, frankly, the number is not the correct answer, because the correct answer to my question is that you cannot tell how much a company actually has made in cash by looking at the income statement. Why can't you tell? Because you don't know which part of the net sales actually have been paid yet. So what we need to do now is to go through line by line by line and ask ourselves, is this line a cash in? Is it a cash out? Or is it not relevant for cash? So let's start off with the first line, net sales. Go back to your accounting course. What is net sales, or the revenues of a business? I hope we can agree. Net sales is not a cash in. What is it actually? In the best case, it's the invoices you actually send out in a given day, in a given year. So sending out an invoice, if you have your own business, you can see that every day in your cash account, is not the same as getting the cash in there. So if you send out the invoice, you have net sales, but not necessarily cash in. So I will help you out here, however, for the moment. For the moment, let's assume that this is here not Apple or Amazon. This is a little French fry stand on the Frankfurt main railway station. And this little French fry stand only accepts cash. So if you want to have French fries, you pay cash. We don't accept credit cards, no checks. If that is the case, then you actually can say, aha, for a French fry stand, net sales is 100% a cash in. Okay, good. So we have a plus here. Plus 100 came in cash from our customers paying their French fries. So what is material expenses? Is material expenses actually a cash out? If you remember some of the income statements we've seen already, material expenses is also called cost of goods sold, at least in the retailing industry. Cost of goods sold. Now that name already implies some consequences for cash. It doesn't say cost of goods paid. It says cost of goods sold in there. So what does that mean? What you don't see in the income statement is if this material has been paid. Because here in the income statement, the accountant doesn't care if something is paid. What you care about is the so-called matching principle. What does that mean? I want to match your sales with the costs you incurred to realize those sales. So let's have a numerical example. Let's assume you go in the morning to the retailer and you buy 10 kilos of French fries in the retailer. And then you actually bring those 10 kilos to your shop and you start selling the kilos. So let's assume on that given day, however, you only sell 8 kilos. So you purchased 10 kilos, but you only sold 8 kilos today. So in your income statement of today, how many kilos of French fries would you show as material expenses? And the answer is, you wouldn't show the 10 kilos, not the purchased kilos. You would show the 8 kilos. Why is that? Because in your net sales figure, you only have 8 kilos of French fries sold. So now we should only actually show those 8 kilos as expenses to match our net sales with our expenses. So what does that mean? The moment you actually have inventory, because that's what would happen, the 2 kilos you didn't sell, they would be showing up in your balance sheet as an asset, in the position inventory. The moment you actually have a different amount which you sold compared to what you purchased that day, you actually have different figures for the cash you actually paid out and the material which is shown in the income statement. The second issue is that there is a question if you actually paid already this material you have in the income statement. Because yes, if you buy French fries at a supermarket, you may be paid in cash. But most companies actually buy their material from a supplier and they pay it after X number of days. So again, this might lead to the situation that in the income statement, you have certain material expenses which might not have led to a cash out in there. So in order to actually now somehow make this case study fit at the moment, I need to make some simplifying assumptions. So what are those? I assume that this company actually has zero inventory and pays all suppliers immediately in cash. This assumption is a total joke. No company does that except the mafia organization, pay everybody in cash. But for the moment, let's assume that is the case. We're a very small company and we buy our French fries every morning at the supermarket and we stay as long until all the French fries are sold. Under those very artificial assumptions, we can say, aha, then the 30 are actually a cash out. Personnel expenses. What is that? Personnel, the salaries you pay to your employees. Is that a cash out? For a large part, it's a cash out. But even here in personnel, you have, for example, provisions for untaken vacation days. You have, for example, payments of Social Security, which is booked already in this year, but it's only paid next year. So again, you have a difference between what you show in the income statement and what is a cash out. So again, let me make a simplifying assumption. Let's assume this year is a mafia organization. Mafia organizations actually don't pay Social Security. They pay everybody in cash under the table. If that is the case, yes, we actually can say personnel expenses is a cash out. What is other operating expenses? Other operating expenses, that would be, the rent we pay for our French fry stand at the Frankfurt railway station. And is that a cash out? Yeah, rent is paid every month. What about depreciation? Is depreciation a cash out? No, I hope we can agree that depreciation is not a cash out. What is depreciation? If I buy myself a computer for 3,000 euros and I actually want to use it for 3 years, under the rules of accrual accounting, which is what we see here in the income statement, we will now split up the purchase price of 3,000 euros over the 3 years and will reduce the value of this PC every year by 1,000. Here you can see the underlying idea of an income statement. It is not about the purchase of the computer. If you purchase a computer, nothing happens in the income statement. It's cash going out from the balance sheet and the computer coming into fixed assets on the balance sheet. It's an asset swap. When does this actually show up in the income statement? When you start using the PC, and then you need to split it up over its useful lifetime in there. And this shows you what the accountant would like to achieve with an income statement. It is not a cash in, cash out view. It is trying to get a realistic view for a given period of how much value added you have given to the world. And for that reason, we actually have the situation that net sales, the accountant doesn't look into, have those sales been paid? That is a secondary consideration for the accountants. What matters for the accountant is actually, did you deliver the product? Did you invoice the product? Then you can book net sales, because this is a value added you have given to the world in this period. The question when the customer pays is a minor detail for the accountant at the end. So we would like to have a realistic figure for the value added you have provided to the world in a given period. And that's the reason why actually we're oftentimes quite far away from cash. Now, with all my simplifying assumptions, we can now say that we have 100 plus, 30 minus, 10 minus, 10 minus, so there's something left. Depreciation, we said, nothing happens in cash. Interest? If you pay interest to the bank, that is usually cash out. So for that reason, it's a minus here. Taxes, do you have to pay taxes? Again, we have an issue here. The taxes for 2020 are only paid in 2021. But in 2020, we estimate how much taxes we will most likely pay for the business year 2020. And let's assume this was the perfect estimate here. So that means that we can say this is a negative as well. So summing up the pluses and minuses, we can now go in the cash flow statement and say, okay, tell me, what are the cash revenues or the cash sales which we actually had in this company here. And the cash sales, we already said, this was plus 100. And then when you deduct from it, the cash expenses. So what are the cash expenses? Wherever we actually put a minus sign here, we now deduct this particular figure. And voila, we can now say how much money was actually left in this company from doing its business. And that's what we call cash flow from operations. So if you go actually in here, you can say 100 minus 75. This gives you 25. This is what people call cash flow from operations, the money left over from the operations. Now, in many textbooks, however, the 25 is determined in a different way. Now, how do many textbooks actually explain cash flow? They give you a formula which leads to exactly the same result. But my point here is I don't want to tell you formulas. You can look that up on the internet. I want to explain you stuff. But just to show you that this leads to the same result, I think many business students have learned by heart for the exam that cash flow from operations can be determined as well by starting the calculation backwards. What does backwards mean? You start off with net income. And net income was 15. And then you ask yourself, did we deduct anything in the income statement? What is non-cash? Yes, we did deduct depreciation. Depreciation is an expense. It's deducted in the income statement. However, it's non-cash. So what does that mean? We need to eliminate it. How do you eliminate something which was subtracted before? Well, surprise, surprise. You add it back. Net income plus depreciation. And in our case here, this would be the 10 which you have here. Gives you exactly the same figure for cash flow, and it's probably the easy way to arrive at this 25. This upper methodology is called the direct methodology of cash flow calculation. This lower here is actually called the indirect method. Now, I have no problem at all if you learn by heart net income plus depreciation gives you cash flow from operations. However, you need to understand why we actually add back the 10. It's not that depreciation is good for cash. There's a very famous exam questions in finance, which sounds like this. Imagine you work for a company which has a cash problem. You need to generate more cash. What can you do to generate more cash? If you just learn this formula by heart, you might think that the right answer is let's increase depreciation. I hope you understand that increasing depreciation is, except for some tax effects, a zero-sum game. Why is that? If you increase depreciation in the income statement, profit comes down. Depreciation is higher, so at the end you will have the same number here, except for some potential tax effects in there. Yeah, so depreciation is not good for cash. It is not relevant for cash. That is the key thing I'm trying to bring across. So this was our entry into the cash flow statement. What I'm trying to tell you here is that focusing on cash makes an awful lot of sense. And where do you see the cash of a company? Well, that's about the only number I trust in your financial statements. Well, I need to correct this. After Wirecard, I have to tell you which I did trust after the bankruptcy of Wirecard, where even the cash turned out to be, kind of wrong, wasn't there anymore. So here in our French fry stand, I still trust the cash. So I visited our French fry stand on the 1st of January. And I counted the cash. So the cash on the 1st of January 2020, I found out, was actually 50 euros. This is a number I trust. I counted them myself. Then I came back at the year end. So what is that? On the 31st of December 2020. And surprise, surprise, I counted again the cash, and it turned out that they actually had 50 euros more in the cash account. So the delta in cash in the year 2020 was actually 50. This 50 euros here are written in stone for me. These is a very important data point in there to find out how the company has been doing. And what is a cash flow statement supposed to do? It's supposed to explain down to the last cent how come cash has increased or decreased in a given period. So we have found now the first explanation. 25 was our cash flow from operations. So selling French fries led to the fact that net, after deducting all the cash outs for the French fries, that 25 euros more should have been left over in the cash register. However, we have 50 more in the cash register. What does that mean? We actually must have overlooked something. There must be another source of cash. So again, hit the pause button for a second and think about it. What other ways does a company have to get cash into its cash register, if not through selling its products? How else can you get cash? Think about, you found your own company. Most likely you will not have any sales at the start of the business. Still, hopefully you have some cash. Where could this cash actually come from? Hit pause, think a second, and then I will tell you where the other sources of cash actually are. So my last comment was, think about your own business. Now, if you think about your own business, which you just founded, then clearly, if you found a business, you usually need money from external investors, from the bank, putting up your own money in there. And this is what people call financing. So we have a second cash flow here. This cash flow is called cash flow from financing. Now, how can you finance your business? You can finance your business through getting an external partner in it. So let's assume this is a big French fry stand. This is McDonald's. How could McDonald's finance itself? Issuing some new shares. This is what people would call equity financing. Or McDonald's could go to the bank. This would be debt financing. That's good for cash. That would increase your cash. Why? What happens if you take out a bank loan? You get more cash in your cash register on the left side of the balance sheet, and you have more liabilities on the right side of the balance sheet. Do we see taking out a bank loan actually in the income statement? No. In the income statement, we only see the interest. But taking out a bank loan is not visible actually in the income statement. So that's the reason why we need a cash flow from financing to reflect those kind of payment streams. Of course, we could have the opposing thing. What is the opposing thing? The opposing thing is we could pay back a bank loan. If you pay back a bank loan, this is what people would call definancing, and this is bad for cash. Can you pay back equity? Yes, you can pay back equity. How? You pay a dividend. That means you take money out of the company to pay back the shareholders. So money shrinks and equity shrinks. Or we pay back a bank loan. That would be clearly the same thing in there. The final point would be share buybacks, very common in the United States. You buy back your own shares. What is that? That's a form of definancing as well. You give money back to your shareholders. And the consequence is less cash in the company's balance sheet and less equity on the right side in there. Now, our French fry stand, no share buybacks, no dividends, no bank loans which were paid back. But we issued some shares to investors. For how much? For 100 euros. So where do we stand here? We now have 100 euros, which came into in 2020 from our investors. Where do we stand? 100 euros came from financing. 25 was left over from selling French fries. That's 125. Now we over-explained a little bit because we only want to explain 50. Well, thanks God, there are some more lines left. So think about it. We now must find a possibility where you can lose cash, where cash goes out of the company in a way that you don't see it actually in the income statement, because we covered that, and in a way that has nothing to do with financing, because we covered that as well. So what would there be for other possibilities? Clearly, the missing link here is now investments. We talked about buying a PC a few minutes ago. I guess a French fry stand would be more buying a new French fried cooker. Now, this buying a new French fried cooker would be called an investment. Cash flow from investments. So let's think about for a second here how investments actually show through in your financial statements. An investment is a pure balance sheet transaction. Cash goes out and French fry cooker comes in. It's a so-called asset swap. Do you see this in the income statement? No, you only see the depreciation. But the depreciation is non-cash. We are not talking about tracking the cash. We haven't tracked yet the investments. So if you invest, this is bad for cash. If you divest, you sell the old French fry cooker on eBay and get some money for it, that'd be good for cash. Now, we didn't get any money for the old French fry cooker, but my assumption here is we paid 80 euros for the new French fry cooker. So where do we stand? We now actually have here 80 in money going through the door for buying a new asset, for buying a new French fry cooker. And we have 100 from the bank. So 100, no, not bank, was an investor. 100 came from the investor, minus 80 gives you plus 20. Plus 25 left over from operations gives you 45. Wow, now we're pretty close to 50. Well, with profit, close is good enough. With cash, there's only one thing, right on target. We are still missing 5. And now comes a very important step. Now I give up my assumption that this company is an all-cash operating mafia organization. Now let's assume this is a real company. This is your company. This is your own business you just founded. Now it would be a total joke to think that if we sold for 100 euros, that we actually got 100 euros immediately in. Nearly all businesses, in particular if you're operating on a B2B basis, business to business, you send an invoice and then you get the money after X numbers of days. So what does that mean? A normal company has receivables. Receivables, accounts receivables, which is abbreviated as AR. Our receivables on the 1st of January 2020 were 20. So keep in mind, I'm moving now out of the idea that this is a French fry stand. This is now a normal company. So we have customers who we actually sold something to in 2019. Those guys actually still haven't paid it, what we sold them, on the 1st of January 2020. So they owe us 20 euros at the 1st of January 2020. Now, the AR, accounts receivable at year end, at 31st of December 2020, were 30 euros. So you can see now the customers actually owe us even more, 10 more. So we have a delta of AR, not AT, AR, of 10. So here comes my question. And again, this is a question where I would like you to think about the answer yourself and use the pause button in a second again. Here comes my question. How much money, how many euros did this company get in the year 2020 from its customers paying their invoices? How much money did we get in 2020 from our clients? That's my question. What I'm not asking you is how many invoices we sent out. I know that we sent out invoices for 100. That's not my question. My question is how much money you actually did get from your clients. If you're thinking about setting up your own business, this question I'm asking you right now is a make or break decision. If you think about Corona financial crisis of 2008, this is an absolutely crucial consideration right now. How much money did you get from your clients? Or to be more important for a startup company, how much money will you get from your clients at what point? So hit the pause button now and write down a number in front of you. What you think, how much money, how many euros this company did get from its clients in the year 2020. Pause now. And the right number is, oh well, there is no right number. Why? I mean, really the perfect answer is you can't tell. Why? You should have asked me first, were there receivable losses? So what does that mean? Did all those people here who are behind the 20 euros of outstanding bills, did they really pay? Or did some of them just die or go bankrupt and they didn't pay? But if you would have asked me that question, I would have told you everybody actually paid as planned. So we didn't have any receivable losses. And if that is the case, we can now go in and develop the answer to my question. So my question was, how much money did we get from clients in 2020? Well, at the start of the year, we had 20 euros outstanding. If everything goes according to plan, we will actually get those 20 here. So what are those? These are the accounts receivable of the year 2019, which were still not paid in the 1st of January 2020. So this 20 is a cash in. Then on top of that, if we would actually now say that we changed our business model on the 1st of January and would actually have told clients from 1st of January onwards, it's going to be cash on delivery. So from the 1st of January 2020 on, we are asking the client, if you want to have French fries, you pay in cash. Okay, then the 100 here would have been on top of the 20, a cash in. So these are the net sales which we have here. So this will be 120. But if you look at it, we didn't change our business model. Why? Because 30 euros were not paid yet. So probably the 30 belongs to the 100 here, which means out of the 100, we didn't get 100. We got 100 minus 30, which is the AR on the 31st of December of 2020. So it's 20 plus 100 is 120 and minus the 30, which haven't been paid yet. And the result out of all of that is 90. So we got from our clients 90 actually. This is the net cash we got from clients. Yeah, so net cash from clients. Yeah. In this case here, what is essential is that we have 100 here in net sales, but we didn't get 100. We got less. Why did we get less? because we gave our clients 10 euros more in terms of a loan in there. Now, if you give somebody a loan, that's good for the client of yours, but it's bad for you. So that's the reason why 90 is the correct answer, really, to my question. Now, if you think about this way, how we define cash here, we actually reflected the full 100 in here. This is not correct. This, for most companies here, is not a cash sale. These are invoices sent out in the best case. So now we find out that's true. We actually didn't get 100 in cash. We only got 90 in cash. Now, if you only got 90, that means that 25 here, which is the same 25 as here, is actually 10 too high, because the 25 includes the full 100. And this is what the accountant will tell you. If you want to know how much money you get from your clients, you have to reflect the moves in accounts receivables. So if there is an increase in accounts receivable, so minus increase, it's bad for cash. Decrease if you bring down your receivables. This is good for cash in here. So in our case here, we now deduct 10 here. So we make an adjustment to the 25. And you will see that in today's world, actually, people feel that these adjustments are extremely important. That's the reason why you will see that many people, when they talk about cash flow from operations, they no longer mean this 25, which we defined 20 minutes ago. They are saying you need to make adjustments to find out how much of this is true cash in there. And that's the reason we now have a second cash flow from operations. And this second cash flow from operations, how is this defined? This is taking the 25 and actually making several adjustments to the 25. Oops, circular reference, not good. Let's try it again. So we take the 25 and make adjustments. So here the adjustment is a negative one. Because we have given our clients more of a loan in there, we have 10 less in the cash register than we actually thought by looking at the income statement. Now, what you will find out that in today's world, the moment you work for a larger company, which reports under international financial reporting standards or US GAAP, they will no longer actually report the 25 here in their annual report. They will focus on this number here. So this is now our new cash flow from operations. This number doesn't really exist anymore, except for small, medium-sized companies who still live in the world of financial nirvana and define cash flow as net income plus depreciation. So 15 is our new operating cash flow. Where do we stand? 100 minus 80 is 20. Plus 15, bad luck, that's 35. And we want to explain 50. Now we've moved away from our 50. Thanks God, we have some more empty lines left. So what's the next line, which we didn't cover yet, which eats up cash or can free cash? We discussed in one of the previous videos, supply chain management. Supply chain management, inventory. And I think you don't have to be a finance guy to find out that if you put more beer in your fridge, you have a highly liquid fridge, but you have less cash. So inventory eats up money or frees money if you just then use all the stuff which you have in your fridge and you can drink beer without having to buy new beer. So let me give you here some numbers. Let's assume that our inventory in this company on the 1st of January was 30 euros. So we had 30 euros of inventory in our balance sheet. Now, at year end, we had actually in the meantime hired McKinsey and they have done a supply chain management project for us. What does that mean? They have brought down the inventory to 20 euros. So we have a delta here in inventory of 10. Okay, so let's understand what the 10 actually means. Let's bring in the world of the grandmother in simple terms. Let's assume that you have 30 bottles of beer in your fridge on the 1st of January. Then you drink 30 bottles during the year 2020. And at the end of the year, you have 20 beer bottles left off in the fridge. So once again, this is a moment where it might be worthwhile to hit your pause button for a second. I hope you understood what I was telling you. 30 beer bottles in the fridge at the start of the year. 30 were drunken during the year, and 20 beer bottles were left over at the end of the year. My question is, how much beer bottles, how many beer bottles, how much beer did you buy, how many beer bottles did you buy in 2020? You did drink 30. I know that. I want to know how many beer bottles did you actually buy in the year 2020. Hit pause for a second, think about it, and I'll give you the solution. So, let's develop the solution together. You can see you had 30 beer bottles at the start of the year, and you drank 30 in 2020. So what does that mean? If you drink 30 bottles and you had already on the 1st of January 30 bottles in your fridge, that means in order to drink those 30 bottles here, you didn't have to buy new bottles. What you did in January and throughout the year 2020, you opened up your fridge door, took out a beer and started to drink. Because you already had bought so many bottles in 2019 that at the start of the year 2020, you had sufficient beer bottles lying in your fridge to cover all your beer needs for 2020. But if you would have done that without buying new beer, your beer bottles in the fridge at year-end 2020 would have been 0. Why? Well, because you had 30 at the start of the year in the fridge, you did drink 30, that means you would have drunk all the beer which actually was sitting in your fridge at the start of the year. But there is no 0 at the end in your fridge, there is actually 20 in your fridge at the end of the year. This is the 20 left over. So what does that mean? You must have purchased 20 beer bottles in the year 2020. So to feel comfortable that you always have sufficient beer bottles in the fridge, you not only did drink all the beer bottles, you made sure that your safety stock of 20 beer bottles is immediately replenished. So what does that mean? Your cash out for beer was for 20 beer bottles in the year 2020. Now, if you remember how we calculated those cash expenses, we included in those cash expenses the full material expenses of 30. Now we're finding out our cash out for beer is only 20. So what does that mean? We deducted 10 too much in here. Now we have to do exactly the same thing, which we actually did do for receivables. We have to now adjust our cash flow for the fact that we just used up some inventory to drink beer. And we'll do that. And again, think about it. If you think about your personal finances, if you do have a fridge, it doesn't come as a surprise. If you fill up your fridge with all kinds of stuff, this costs you money. So in this case, we brought down the fridge content, and this is good for cash in here. So we now made up for the bad cash impact of the receivables by bringing down the inventory. So now we are back again to 0, minus 10, plus 10. But we're back again to, unfortunately, the situation that 100 minus 80 is 20, plus 25 is 45 again, and we would like to explain 50. Final step. One line is left. And what is left? That's what people call accounts payable. So accounts payable, up. Let's make it nice. Accounts payable on the 1st of January 2020. Now, let me tell you, the accounts payable were 15. The accounts payable at year end, that's the final mental exercise I need from your side, mental effort. This number I leave empty because I will ask you in a second how much we actually have to enter here. But before I ask you, what is the content of the cell? Let me show you here the complete version. So delta AP, we don't really have a delta yet. Let me ask you a preceding question before I come to the question of what should be the accounts payable at year end. Think about it for a second. If you increase your accounts payable, is this good for cash or is this bad for cash? I will copy this here in the meantime. So if you understand accounts payable, what accounts payable are, then I think it is possible to understand that the later you actually pay a supplier, the better it is for your cash. So that's the contrary of accounts receivable. In accounts receivable, you gave a loan to the client. That's bad for your cash. In accounts payable, you obtain a loan from your supplier. And that's good in there. And is this something where you need an MBA for? No, think about it. Every alcoholic knows that if I can convince the bartender today to write down the drinks, that means I can get drunk for free tonight. Yeah, this is exactly the logic of accounts payable in there. So the pluses and minuses are reversed. The more accounts payable, the better. If we know this, we are now moving in and can actually explain what this number has to be down here to make my equation square. Which equation am I talking about? The equation I've been using several times right now. Let me show you my equation. If you add up the money left over from your operations and then go into your investments and ask what is the money we spent on investments, and then add up your financing. So if you take A plus B plus C, you need to get exactly this number, which is D. So the delta in cash, D, equals A plus B plus C. This to me is the most important equation in finance. Yeah, because here you obviously see in many times where the problems of the company actually are lying. So let's fill this with blood. D. D we know. We have counted and found out that at the start of the year we had 50 more in the cash register. So A is 50. No, sorry, D is 50. A we don't know yet. Why don't we know A yet? Because we're lacking the accounts payable. So A is not complete. So A is our question mark, our X. We need to solve for this unknown. But we do know B. B, we do know, is minus 80. And we do know C. C is plus 100. Okay, so 50 equals A minus 80 plus 100. So let's do math. Minus 80 plus 100, that's plus 20. So 50 equals A plus 20. Any gross estimates for A? Can we roughly settle that A should be 30? If A is 30, then the equation actually fits. Now at the moment A is 25. So here comes now my final question. I would like to have 30 here as cash flow from operations. Help me out. Which number do I need to put here into this cell? So cell F20. In order to make sure that we get a 30 here as cash flow from operations. Hit pause for a second, think it through, and then I will tell you what the right answer is. So we need 5 more. 5 more. That means accounts payable, the more you have in accounts payable, the better for your cash. If you actually put 20 here, then you would actually have a delta of accounts payable of 5. So you increase the loans you obtain from suppliers by 5. That's good for cash. And that means we have plus 5 here. And in that case now, our equation fits. 30 minus 80 plus 100 gives you plus 50. I fully realize this is not that straightforward. However, let's take a step back. Think about how you manage your personal finances. You don't have such fancy terms, but think about what your operating cash flow is. Your operating cash flow is the salary you get from your employer, minus your rent, minus your grocery bill, minus your telephone bill, minus. Whatever you then have left over, this is what people call your cash flow from operations. So in this case, plus 30. What is the 80? The 80 is the new refrigerator you just actually purchased. Is it a problem that this refrigerator did actually cost you more than you actually earned up here? No, it's not a problem. Why is it not a problem? If you can convince a bank to give you a bank loan, or if you have a rich sister, which gives you an equity injection, then you can buy the fridge. However, the bank will be worried about the fact that if we give you this in form of a bank loan, are we confident that you have sufficient cash generation up here from your job in the future to make pay for all the investments of the future and still have money left over to repay the bank loan? And this is another final term from my side, which is an important term that you understand it. This discussion of the bank of how much money is actually left over from your business, including the investments you actually are undertaking, is called the so-called free cash flow. So what is a free cash flow? The free cash flow is defined as A plus B. So we have 30 of cash flow from operations. We spent 80 on investments, plus 30 minus 80. That gives you a negative 50 in this case. Yeah, so negative 50 here, so that's plus 30. Yeah, let's make sure we see it. Plus 30 minus the 80 gives you minus 50. Is this bad to have a negative free cash flow? Well, you can ask Elon Musk. That's totally okay to have negative free cash flows for quite some time because you're building beautiful new plants in China and in Berlin. So you have huge investments. If investors trust that those investments will lead to the fact that this number up here, the cash from operations, will explode in the future and become a hugely positive number, you might still have a negative free cash flow, but are worth 200, 300 billion in the stock market. Why? Because people have the confidence that those investments will actually pay off handsome. So what is the mantra of financial theory when it comes to what you should do as a corporate manager? Long-term, sustainable, free cash flow growth. An investment is not good or bad per se. An investment should be checked if this investment helps you to generate more cash in the future and there, so that you get the original investment amount back and something on top. So everything you look at in terms of finance should be checked in terms of, does it help you to actually generate more free cash flow in the future, long-term sustainable free cash flow growth as the key metric in value-based management in the objective of increasing the value of your business. I hope this quite complex exercise was somewhat understandable in there. This would now be obviously something we need to practice by looking into cash flow statements and annual reports, trying to interpret them and trying to get a bit of practice of what the important numbers within a cash flow statement actually are. Thank you.